Good afternoon, everyone, and welcome to another one of Avant-Garde's free educational trading webinars. We are thrilled to welcome guest presenter Chris Verhaegh with us this afternoon. He is here to teach us all about trading silver in a horizontal world. I want to thank you all for reading through those disclosures before we get started. Just a brief little note on Chris, a little background here. Chris has had a lifelong interest in precious metals, starting from his teenage years, where he was assisting his uncle at coin shows, taking him into young adulthood, where he honed his skills learning how to trade gold and silver, and ultimately culminating in him sharing his years of experience trading with others now through education, via newsletters, presenting at seminars, conferences, sitting on different boards, and even consulting for different banks. His extensive experience in trading options on silver is welcome here as Chris aims to help educate others so they can further their trading goals. And we are thrilled to have him join us this afternoon. Chris, are you with us?
Yes, can you hear me?
Yes, I can, loud and clear. Thank you for taking the time this afternoon to join us and teach us all about trading silver, getting into the details on calendar spreads, a little bit on diagonal spreads, and getting into the nitty-gritty with us. We are ready and we are excited. So when you are ready, you can go ahead and take the screen control and share your screen and pull up your presentation. And while you are doing that, I will remind everyone here live in the Zoom room with us, if you have questions during Chris's presentation, please type those questions into the chat box or the Q&A box, and I'll get those over to Chris to address at the end of his presentation. All right, I can see your screen, Chris. Looks good, so take it away when you're ready.
Okay. Hi, everybody. My name's Chris Verhaegh. Pleasure and honor. Natalie, thanks for having me. Let's get into this. Now, again, I started trading or buying silver in the late 70s when it was under $4 an ounce. It went up to 50, it went back down to 5, and hopefully we'll never see 5 again. We might not ever see 50 again for that matter. Real quick, some housekeeping. This is copyrighted material. This is my presentation. This is my intellectual property. This is presented for your entertainment, education, um, all sorts of stuff, but not for you to resell. Myself, all my team, we do this not as a recommendation to trade anything. This is purely educational. You can read that. I want to get into this. Um, I am a unicorn when it comes to silver. And I say that because I've worked in the coin dealer realm. I worked um, in the refining the mint, right? I went to China in the mid 1980s on a diplomatic visa. They had members from mints all over the world go there. Now, I did not work for the U.S. Mint. I worked for a private mint. I did get my commodity license Series 3. I've let that expire. I'm not currently a commodity broker. I'm going to tell you something real quick. Commodities are complex. This is not going to be about silver, the silver commodity, silver futures. I will mention it to you, but more mention it to you why you kind of don't want to do it. Um, I extensively trade and I write option newsletters and I give webinars. I would love to hear your thoughts on silver. So Natalie will give those to me at the end, but write down any questions you might have or type any questions you might have. I want everybody, I'd like to know everybody's opinion. Um, I do want to tell you that my methodology of teaching is to have everybody have an aha moment, right? My father was a carpenter, and so he'd jokingly slap his forehead and say, "Oh, 2 by 4 moment." It's like, "Oh, duh, I didn't get that. Oh, now that makes sense." So there's a lot to it. Hopefully you'll have lots of aha moments, but feel free to ask any questions if you have those. Um, Silver is a metal, right? It's AG is the periodic symbol. AU is the periodic symbol for gold. I trade gold options as well. Right now, I'm trading a lot of silver options. The math is just too good to not trade silver options, right? And there's a couple of things I want to share with you that work on everything, right? Whether it's gold, silver, stocks, right, bonds, and so I teach them as mantras. One of my mantras is obvious is a function of familiarity. My kids know not to say, duh, Dad, that's obvious, because then I'll say to them, obvious is a function of familiarity. I'm not familiar with technology, so don't give me a hard time when I don't understand it. I'm not going to give you a hard time if you don't understand silver, right? I'm going to try and make you familiar so that the decision to trade it becomes obvious. Another one of my mantras is that the last share traded values all the shares in existence, right? Mutual funds price um, price out on a quarterly basis. So the last trade of the last day of the quarter, that's what they put in their statements they send out. The closing price of a stock, right? That's what everybody's stocks are worth, right? Well, during the market's open, the last share traded values all the shares in existence. And that's true with silver. But silver comes in different forms, and the last share might be in a different form. And so you'll hear a lot of guys talk about silver spot value, right? Silver spot value. Well, silver spot is technically the price for physical silver at that exact moment. And a lot of coin shops and bullion dealers will look at the futures market to calculate spot, right? Spot is whatever they tell you what it is. In the physical silver world, there's not really much price discovery. You know, uh, when I was doing business 40 some odd years ago, we had a guy down the street said he sells for, you know, at spot, and then you get to his shop and spot for him was $5 more than spot for us. And he said, I don't care what other people are calling spot. I call spot this, and I sell it at spot. So he's defining the terms, right? And and a lot of experience with physical silver and tons of experience with uh, options on silver, right? With physical silver, there's a commodity delivery bar. It's basically 1,000 ounce bar. It's been assayed. It's held at a secure vault. And if someone buys a silver futures contract that they want to take delivery, basically they get a, a, a receipt, for better words, that, hey, that silver in the vault now belongs to you. They can take physical delivery. That's a process. That's an expense. But most silver is traded with just the ownership switching, right? Physical silver, the United States Mint produces silver eagles. There's my mint, what we worked at, we did a lot of smaller bars, 5, 10, 20-ounce bars of silver. We would also trade 100-ounce bars, and we struck a lot of silver rounds, 1-ounce rounds. That's physical silver. Physical silver can also be 90% coins, right? That's dimes, quarters, and halves, 1964 and before. The 1965 to 70 half dollars were 40% silver, right? Canadian coins were 80% silver, but back in the day, they were sterling, which is 92.5%. And physical silver can come in the form of scrap, right? When I worked at the mint, we'd buy all sorts of this stuff. We'd never melt 90% silver, but we'd melt all this other stuff and turn it into bars or rounds, right? Non-physical silver consists of like silver futures on the COMEX, silver futures, Chicago Mercantile Exchange. Non-physical silver is silver outside your possession, right? If you own silver and someone's storing it for you, I wouldn't call it physical silver. But the non-physical silver we're going to talk about today is the exchange traded fund, SLV, right? That's the ticker symbol. It trades similarly to a stock. It has options similar to a stock, except it has expirations Monday, Wednesday, and Friday, not just Friday, right? It also has options on a quarterly basis if the quarter ends on a Tuesday or a Thursday, right? This is what I trade. This is what we're going to talk about. But I'm always going to refer back to maybe physical metals, right? Physical metals, a a broker or a dealer might want to charge you so much above the melt value, so much below the melt value, and then melt is a condition of spot, and they can call spot whatever they want. And how much above or below they want to pay or sell for can change. One of the things I like about SLV, it's pretty constant. It doesn't change forms. SLV is the same as it was, and it's the same as it will be. The price just goes up and down, right? In physical silver, the price difference between buying and selling could be 7, 8, 9, 10, $12 an ounce, right? We consider that the cost of doing business. If you buy a silver eagle for somebody for $3 over spot, yay, and then you decide you want to sell it and he offers you $10 under spot, right? That's a 13-ounce spread. If there's nobody going to sell you a silver eagle for $1 more than what they pay, right? They can't stay in business with that tight a bid-ask spread. But with SLV, the bid-ask spread is in the pennies, right? In the pennies. In physical silver, you can't do price discovery. How do you know what physical silver is worth when different brokers, different dealers have different quote unquote spot, right? There's no real electronic exchange that you can go look up quickly and see what the bid ask is. Now with SLV, we can look at it, we can get a quote, prices change throughout the day, right? You can look at a chart, you can do technical analysis. So here's a chart of SLV. This my staff took this over the weekend, and try and annotate here. This is kind of new to me. All right, you see it goes up, and then the last day of January it sold off, right? And then we've kind of been in this long trading range. So back here, the way to make money in silver was go long. Don't confuse brains in a bull market. You're making money because silver's going up. Here with silver going sideways, right? Silver going sideways. And how do I remove that? Will it go away when I change slides? Let's see. No, it doesn't. Hold. Sorry about this. Third drawing. There we are. Okay, sorry about that. Different webinar platforms are different from each other. So silver, when you buy physical silver, you got to pay for it, right? No one's going to let you out the door owing them money, right? When you buy SLV or for that matter, silver futures, but let's not talk silver futures. There's potentially margin, right? You can, like a stock, you can put up half the money. If it's $100, you put up 50, the dealer will, or your broker will loan you the other 50, right? That's the margin as a secured loan. There's margin if you sell short. They want so much money up front. By the way, don't short silver. It can spike so much higher so quickly, it can destroy you. And that's certainly the case with silver futures. But margin can also be the maximum risk in a vertical spread. Margin can also be the maximum vertical component of a diagonal spread, right? So there is no margin on silver options. You got to pay for it. You have to have that money and you pay for it. Now, I kind of call people that are really into silver foamers, right? They get so excited. They're like foaming at the mouth. It's you might be really into silver and you might say, hey, I'm a stacker and this and that. But, a lot of the dealers are laughing behind your back, calling you foamers. And then there's FOMO, which is the fear of missing out. These are the people that when silver was $4 an ounce, we had a deli near our office, and I go in and I tell the guys at the deli, hey, I'm buying all this silver. It's $4 an ounce, and it's $6, $7, $8, 10. You got to buy it. You got to buy it. 10, 15, 20. You got to buy it. You got to buy it. 25, 30, 40. And then when it hit 50, they came in and said, all right, I want to buy silver. So you know what I did? I sold all my silver, right? I sold all my silver because the fear of missing out, the last person to buy, there's no one else to buy after them, and it goes down. And so people, and I saw other people that bought it at 4 and said they're going to sell it at 10. And when it went to 10, they said, okay, I'm going to sell it at 20. When it went at 20, they'd sell it at 30 and so on. When it went to 50, they said, no, I'm going to sell it at 100. And guess what? They waited 40 some odd years. So these people make money when they're long only. All their profits come from price appreciation. And I say that FOMers and FOMO, it always ends badly for both of them unless they understand put options, right? We'll talk about put options here a little bit. Again, started in the world with physical silver, refining scrap, refining non-pure, turning it into pure. An interesting thing, the mint I worked at went bankrupt before I worked there because silver went up to 50. The owner of the mint was a genius. And then when silver crashed, he crashed. And the banker, instead of letting the get sold off for pieces, he bought the mint at pennies on the dollar. And I just happened to be at the right place at the right time. And I started working there. And he taught me how he runs a mint, and he hedged. And it was life-changing for me. I'm hoping this presentation is maybe the start of life-changing for you. So to me, smart money is not silver futures, because futures and commodities, that's complex, right? A commodity delivery bar is 1,000 ounces. You're talking 80,000, and if it goes up 100,000, maybe $200,000. No, that's not smart. You got too many eggs in one basket. Now, if you're worth hundreds of millions of dollars, that's a different story. We're going to talk about the silver ETF SLV. Silver SLV, one share correlates to 1 ounce of silver. And we're going to more talk about option contracts where there's 100 shares, so it correlates to 100 ounces. The fee structure is such that the bid-ask spread is in pennies, right? Not only on SLV, but even on the options. On occasion, you might see the bid-ask spread in dimes, but you're nowhere near $8, $10 for a physical ounce. There will be exchange fees. There might be brokerage fees, right? But the cost of doing business is nothing. Now, the beauty also with SLV is there are tools for price discovery, right? This was from a few months back, right? Now I know how to annotate. I'm going to annotate, right? Here on this day, you see there's 19 or 1.9 million call contracts traded, 1.4 million put contracts traded. This will change day by day. You can kind of get a consensus of traders by looking to see if they're trading more calls or more puts, right? More calls or more puts. All right, so let me clear my drawings. There we go. Price discovery. Another way for kind of price discovery is price projections. This is the average implied volatility by expiration. Now this was, I'm going to keep this up here. Oops. This was taken 3 days before January 12th, right? This was $72 on the way up, right? It hit over 100 and then crashed down, and now we're in the 70s, 80s. And again, SLV trades for less than silver futures, right? Silver futures are complex. So again, that's, what is spot, right? But I want you to see the implied volatility, 60, 70%, further out in time in the 50s, then it drops into the 40s. Now, this number here, this plus or minus is how much options are projecting that silver will go up or down in dollars and cents by expiration. Here, 3 days before January 12th, they were predicting silver would go up or down $2.71. Basically, they're saying, hey, you can go up to, $75 or down to $69.50, right? Their projection for a 2 years off in the future that gold or silver could go down $45. Well, it went up over $45 from this price, in less than a month. So this is price projection. Here's a more current price projection. I took this one earlier today. You can see that the implied volatility, right, is higher numbers. Here we're in the 60s and 70s off into the future. The higher this number, the more expensive options are. And that's not necessarily a bad thing. Quite often that's a good thing, especially the way I trade, right? But physical silver, you have no idea where it's going. Here, option market makers are telling you what they're pricing options at, right? And if you get a move bigger than this, right? Options are cheap, right? Options are cheap. Can you trade silver options in your IRA? Absolutely. If your broker says no, change brokers. SLV options are a very efficient use of capital. 100 ounces isn't $8,000, right? 100 ounces is one contract, and one contract might cost you in the hundreds of dollars. An efficient use of capital, right? Additionally, if you buy $8,000 worth of physical silver and silver crashes 60%, which it is possible to do, right? If you bought 8,000 and let's say it dropped 50% in value, you lost 4,000 bucks. If you buy options for hundreds of dollars, your risk is limited to hundreds of dollars. Unlike a futures contract, this is why I don't want to go into futures. Futures, you have risk beyond the security deposit margin you put up. Options are not only the most efficient use of capital, they're the best risk way to trade, right? Now, options have two sides to a trade. There's buyers and sellers. You can buy an option, which gives you the right. You can sell an option, which gives you an obligation. There's also two types of options. There's call options and put options. Calls give the buyer the right to buy the stock. Call is kind of like a bet that the stock's going to move higher, or in this case, silver's going to move higher. A put, you can say it's a bet that silver's going to drop, but you can also say it's insurance in case it drops. Now, when what I do, this presentation is not about buying a call, hoping the market goes higher, or buying a put, hoping the market goes lower. This presentation is about spreads. And my last presentation with Natalie back in January was on vertical spreads, right? I encourage you to watch that video. If you don't know how to get it, ask Natalie. She'll get you a link to it. In vertical spreads, you're buying a right and you're selling an obligation, right? In vertical spreads, you're buying a right for a certain expiration and you're selling an obligation that expires that same expiration. You have predetermined risk and you have a maximum return. So back then, I shared this slide here. This was when silver was $72.17. This was on January 9th. This spread cost 280. And I gave this presentation, I think, on January 15th. And so I showed by January 13th it had moved from 280 to 358. 2 weeks later, it moved up to 460. And then a week after that, silver had crashed, right? Silver had crashed. All right. Now, this is kind of a good move, 280 to 460, right? That's a $1.80 profit. That's more than 50% in just less than 3 weeks, right? Less than 3 weeks to make more than 50%. That's exciting, right? Silver, when silver was at 72, it'd have to go to 108. And with physical silver, with the premium above your pay, the discount below you sell at, you cannot get these types of returns, right? And so it kind of begs the question, let me clear this off. It begs the question, click, does history repeat or are these one-off, right? Well, these are the March, this example here is the March option, right? It went from 257 up to 4.25, right? So, well, I would say, the problem being that these are the same days, but the point there is there's numerous choices to make, right? this presentation isn't necessarily to show you what the best is, it's to show you what's out there, and then we can talk later on what might the best be, right? Again, are these one-off, right? Well, they take some timing both on your entry and exit, because these spreads that I'm showing you right here now, you know, went higher than what they were. Well, silver's back in the upper, or SLV, to me, that's silver. SLV's, higher than it was on January 9th. So these spreads are more. But, you know, when you buy physical silver, the cost of doing business is so much that you have to write out the dips, right? With SLV options, you don't have to write out the dips. You can profit, buy and sell. You can trade your way through it, right? The more time you buy, the more it costs. Not necessarily, right? Here's April options, 244. They went to 408. They're not necessarily costing more because they're in the form of a spread, right? We're going to go forward here. This is December, went 231, right? December's cost less than April's. But what's even crazier that this is $10 widespread as opposed to a $5 widespread on what I was previously showing, right? There's a lot to this. We're basically trying to show you as much as we can, as quick as I can. Cost of doing business in physical silver, it's dollars per ounce, far more than the pennies per share in SLV, right? Does history repeat? Is there an easier entry and exit? And I say, yes, horizontal spreads, right? A vertical spread is the same expiration, two different strike prices. A horizontal spread is the same strike prices, two different expirations. This is out in time, long term, right? And this is the short term, and that's where we get horizontal from, right? So I'm assuming everybody's going to watch the recording of this. Here's the absolutely definition. It's basically called a calendar spread. You buy a long term, you sell a short term. A diagonal spread is a horizontal calendar spread with a difference of strike prices. So there's a vertical and a horizontal component, right? With calendar spreads, do you have to wait until expiration, right? No, you can open and close these. You have a right. You buy a right, you sell an obligation. You always have the right to buy to close your obligation you sold to open. This next slide, this is the most important slide in this presentation. Pinning is winning. When I do a calendar spread and I buy a long-term option, I sell a short-term option, the short-term option decays as time passes, right? And this curve represents the decay. And at expiration, it becomes a flat line, right? But with a calendar spread, I can either open it and close it, right? I can buy to open the spread and then later on sell to close the spread. That gets me in and that gets me out, right? Or sometimes I can buy to open, right? Well, actually, what you do is you buy to open the long-term option, you sell to open the short-term option, and then later on you buy to close the short-term option and sell to open an option further in the expiration. This is called rolling. The most credit to get to roll is at the money. The term pinning is this is the at the money strike price, right? Over here might be in the money. Over here might be out of the money. Forgive my penmanship. But if you can pick the at the money strike price ahead of time of where it's going to be at expiration, that's where you make the most money. All right, come on. So here's a $75 calendar spread I entered on February 10th. Right? I entered on February 10th. I paid $6, which is $600 per contract, right? There's 100 shares per contract, each one of them. So $6 $6 each times 100 is 600. On February 11th, the next day, I rolled my short, right? This spread had me buying March 20th and selling February 11th. I bought time. I bought the long-term option and I sold the short-term option. And the very next day, I rolled the short-term, right? I bought to close the short. I sold to open, right? This is a Wednesday, right? I did this on a Tuesday. I rolled the next day on a Wednesday from the options expiring that day to the options expiring on Friday. At that, bringing in $150 on $600, I now only had $450 at risk. On Friday, the 13th, I rolled to the 17th. I brought in 27 cents, right? On the 17th of February, SLV was below 75, so I just let my short call expire worthless, right? Now here's where it gets a little complex. I sold the 74 and a half call. I sold it for 28 cents. I sold the 74 and a half because the 75 call would bring me less money, right? I then, at that point in time, I had the risk of having to deliver the silver at 74 and a half, and I had the right to buy it at 75. So I was kind of upside down, but I was just doing this for cash flow purposes, right? Next week, or excuse me, the end of that week, I bought the 74 to close and I sold the 75, but I sold that following Monday and I brought in 84 cents. And then I rolled for 85 and 68 and 105 and 105, excuse me, 107 and 105 and 118 and 90, right? That bell curve of time, right? The highest would have brought the most money, right? $1.18 was closer to being pinned than 90 cents, right? I was a little bit in the money when I brought in 90 cents. Bottom line is, all these rolls here have added up to $862. I paid 600, I collected 862. I have $262 profit and the trade is still open, right? This is Friday's option. This is tomorrow. So what's going to happen on tomorrow? I'm going to roll from Friday to Monday and then Monday to Wednesday. And then Wednesday, I'm going to close the trade. I've got 3 more rolls. And if I can bring in, somewhere around $1 a piece, my 862 might go up to 1162. Who knows? I might be able to bring in a total of 1200. I might be able to bring in 100% on my money, right? I start with a certain amount of risk, and as I roll, the risk drops, right? As I roll, the risk drops. Click, clear. So this is with calls. Here's puts, right? I started this put on February 26th, right? I paid $4.01. I brought in $1.70, right? $1.70 is fairly big money. That means the stock price, or excuse me, silver's price was near 80 when I rolled. Here you see I'm rolling for 30 cents because it was way away from 80. The closer the price is to your short strike price, that's called pinning. That's X marks the spot. Anyway, rolling this, my total credit that I brought in is $399. So technically, I have $2 in this trade still. My risk is the debit. My risk was $401 when I started, but my risk was not $401 because I had more time. I had 320 and I was short 32. And there's 3 expirations a week. I can just roll, bring my money in. Now it worked the 75 call. It worked the 80 call. Here's the 70, excuse me, here is the 80 put, right? I started on January 30th. I closed on February 17th, right? That was 18 days, which 18 calendar days, 11 trading days, right? Because there's weekends. And lo and behold, I put out 620. I brought in 718, which is a $98, 15.8% profit in 3 weeks. this is where I wish I could see you guys. I'd say show of hands here. Who would like to make 15% in less than 3 weeks, and who'd like to do it over and over and over again? And then I would obviously I'd get someone says, I don't want to be in a trade for 18 days. I don't want to be in a trade for 1 week, let alone 5 or 6. Well, here's a trade I did. This is a diagonal spread. I bought the long term March 20th. I sold the short term February 20th. I did this on February 19th. I bought the 72 and a half call. I sold the 72 call. I paid 428. The very next day, right now I live in Mountain Time Zone, so this is an hour and 8 minutes after the open. That uh, This is also an hour and 20 minutes before the close I bought. So an hour and 20 minutes before the close, an hour and 8 minutes after the open. So I wasn't in this thing 3 hours worth of market time. I sold for 475, right? That's roughly 10% overnight. That's maybe a trade you might want to make, right? It's all up to you. There's numerous ways of doing it. In diagonal and horizontal spreads, more time absolutely costs you more money. Now, here's the thing. You might be saying to yourself, man, I got to be a rocket scientist or a brain surgeon, or even more complex, a rocket surgeon or a brain scientist to understand this. The beauty of this with expirations every, 3 times a week, you can paper trade and see how you're doing right away, right? When someone says, oh, hey, I know the next Amazon stock, I know the next Google stock, I knew the next Netflix stock, their implication is you buy the stocks now and then 5, 10 years from now, they're worth hundreds of times what they are. How do you practice that, right? How do you practice it? How do you know? You don't know. But with SLV options, having 3 expirations a week, right? You can practice. You can when this webinar is over, you can paper trade by buying a March 31st, buying an April 17th, and selling tomorrow Friday, right? And then Friday, see how you do. Can you close it for a profit overnight, or do you have to roll, or do you want to roll? Right? I often like rolling, right? I often like rolling because I'm just piling on money and money and money. I have far more positions than what I've just showed you here, right? There is a bit to it, right? The bottom line is that this is a target-rich environment. You got to find a strategy that fits your situation, right? You want to know what are the best days to trade. You can trade this every day without day trading it, right? You saw that example where I bought on February 19th, held overnight, right? I was in it for just less than 3 hours of market time. That's overnight trading. There's no day trades involved here. There are day trading regulations which are in the process of possibly changing here in the next few months. So, there's just so much here, right? This is the tip of the iceberg. This is the tip of the iceberg. And if you'd like to know more, you can email me here. Um, Natalie gave me 40 minutes. I think I used 38, so I got a little bit of time for questions. Natalie, anything?
Yeah, thank you so much, Chris. I'm going to ask you to leave that slide up just for a minute so everyone can write down your email address because, inevitably someone will come up with a question after the fact. And as you noted, that was a ton of great information. Of course, we all know you could go for hours talking about this topic and all the different possibilities. So, we appreciate you attempting to get it to a manageable time frame for us to ingest. So everyone, please write down that email, reach out to Chris if you have follow-up questions. We did get some questions during your presentation, Chris, but then you addressed them in later slides, so that worked out well. I will pass along more of a comment, I suppose, or to get your opinion on from KM. They were saying that from their reading, they're getting the sense that silver is now in a structural bullish environment. Do you have any opinions on that phrasing?
Well, here's the consensus. The consensus in silver traders is that the usage of silver, whether it's in solar arrays or possible in fast charging batteries for EV automobiles, the physical demand is greater than the mining production, right? There's very few silver mines out there focusing on silver because most of the silver that comes out of the ground comes out of copper mines, and it's like a added bonus for the copper miners. And so there's projections that the world is going to run out of silver. Well, having bought so much scrap silver and refined it over the years, I'm going to let you know there's lots and lots of scrap out there, and the price goes high enough. You can tell somebody that the spoon in grandma's place setting, right, has got $50 worth of silver, and they say, "Oh, we've got a 12 place setting, and that means there's $600 worth of spoons, and there's probably $600 worth of forks, and probably another $600 worth of knives. And if silver goes up, there'll be a point where there's $100 worth of silver in grandma's, flatware, and people will start melting that. And so there's recycled silver, which kind of throws a kink into the equation. But how I don't have an electric car. How long does it take to charge an electric car? Well, if you had a silver battery instead of whatever they're making, it would charge in just a fraction of the time, but you would need pounds of silver, and the silver battery might be $6,000, but there are people that would gladly pay an extra $6,000 so they don't have to sit at the charger, on a road trip or whatnot. So there's going to be a lot of demand for silver. We're basically in a bull market, but we're in this price discovery stage, and these horizontal and these diagonal spreads absolutely work best in a sideways market. And that's right now what we're in. And you can add a horizontal component. You can buy, let's say you think silver's going up, you buy a long-term $75 call, you sell short-term $80 calls, you roll the $80 calls, bring in enough premium to get your 75 for free, and then lo and behold, if silver's well above 80, someone's going to call you out at 80, right? Because you're obligated to sell it at 80, but you've got the right to buy it at 75, and so you can make $5 an ounce. To make $5 an ounce in physical silver, you have to have it go up about $13 because there's about an $8 uh, cost of doing business in physical. So there's two things for people to do here. If you if you want to make money in physical silver, it's a lot easier here. Make your profits, then go buy physical silver. And if you don't care at all about silver, this is just easy to make money on. That high implied volatility I showed you in the 70% range means you can get fair amount of money to roll one Monday to Wednesday, Wednesday to Friday, Friday to Monday. So it's target rich environment.
Gotcha. Thank you, Chris. And we did have a question coming in from Craig. You mentioned rolling. Can you just briefly explain what's the benefit of rolling?
Bring in a net credit each time. So here's the thing. A long-term option, let's say, costs $6, and let's say it's good for 6 weeks, right? You might say, okay, hey, $6 for 6 weeks. You might say, oh, hey, that's $1 a week, right? That's kind of easy math, right?
Mm-hmm.
But a short-term option might cost 75 cents, right? And that's good for just a couple of days. So if Monday's worth 75 cents and Wednesday is worth 75 cents and Friday is worth 75 cents, right? That's 2.25 for a week. 2.25, and you can roll 6 weeks, right? You can, and there's going to be what's called slippage, right? But if you can, in a non-perfect world, bring in $12 on a $6 investment, that's why you roll. Options decay like this. The short-term options decay really fast. So we're buying an option here that's decaying this way, right? Decaying this part, and we're selling an option here that decays that way. And then we do it again and again and again. Lather, rinse, repeat.
And just as a follow-up, Craig's asking or pointing out that you rolled the strike price down each time. That's what you're saying?
No, you're rolling from Monday. You buy to close Mondays, you sell to open Wednesdays. You buy to close Wednesdays, you sell to open Fridays, buy to close Fridays. On occasion, I'll move strike prices up or down because
Mm,
I'm a pro at this and I can pick up a couple extra pennies here or there. If in my 75 example, if I would have just rolled the 75s, I might have brought in a total of 2 or 3 cents, which is $2 or $3 less, but I'm trying to maximize stuff. And I'm also trying to show my real world examples. Understand that in this audience today, there are super advanced traders, and me pointing that out that you can do that, they say, oh, wow, hey, I can maximize this. Well, in a sense, I showed that at the expense of simplicity for newer people. That's why I say reach out to me and we can kind of tell you, you know, we can give you more information.
gotcha. Yeah, thanks for the explanation there. We are pushing right up against our time frame. Thank you so much for answering those questions and for everyone who's asking questions. I'm going to remind you all, write down this email address because there are a couple more questions coming in. Chris, real briefly, I know you very briefly touched on the proposed possible change to the day trading rules. Just to clarify, no changes have been made currently, correct? There's still the
Yeah,
existing
no,
day trading rules.
FINRA's investigating it, so
Got it.
I trade over 25,000, so it doesn't matter to me. But I've got
Right.
my kids trade and they don't have 25,000 in their account, and so it's more
Sure.
important to them. That
Right. So yeah, I'm sure to Michael, shout out to you. I'm sure if and when any changes are made, we will be seeing that all over all over the news. So I wouldn't worry about missing that if any changes do end up coming
yeah,
down.
you'll know about it. The
Yeah, for sure.
the bells and lights and whistles all go off. So
Absolutely. That would be quite the change. Um, yeah, so thank you again, Chris. I really do appreciate the time and the effort that you put into these presentations. And thanks for answering questions. And to those of you who are with us live and those who ask questions live, thank you very much for engaging. It always makes these webinars more beneficial for everyone. So we do appreciate it. Just a reminder to check your email inboxes. You're going to get an email with the link to the recorded replay from info@tradeagt.com. And you'll also get your free giveaway from Chris's group separately. So keep an eye out from that. Thank you, everyone. We will see you at our next educational webinar. And until then, good trading to all. Thanks again.
thank you, Natalie. Thank you, everybody.
Thanks, Chris. Bye-bye.